some of it does appear to be transient or idiosyncratic.
There is a possibility on the other side of this that inflation could actually be quite low. Inflation has persisted longer than we thought.
You know, I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, as today's video is on the corporate debt schemes that seem to be skyrocketing across the nation. Now, after that segment, we're also going to give a deep dive report on the status and health of the private credit market. And I'm going to tell you guys right now, it's not good, and it's not good at all. And if we already have problems in the regulated part of the financial industry, what does that really say about private credit, which is much more unregulated? It says that there's massive turmoil. And our ending segment is going to be on how the Federal Reserve is starting to flip, or the market is starting to think that the Federal Reserve is flipping. I'll start by scrolling down on your screen to show you guys that in the last year, Fat Brands, which has absolutely, it appears anyways, I mean, you guys see it right here, has destroyed their company. Their stock is down in 1 year, 85%. Now, the big question is why, and who is that affecting? As always, don't forget that the slides I use in the videos are posted both on Facebook and X. So go to the Real Estate Mindset Facebook, join the conversation. This article came out a couple days ago titled "Fat Brands Lenders Demand Immediate Payment on $1.3 billion in Debt." So I've basically taken 3 points of that article so that we can talk about the most important points. Point number one, UMB Bank, the trustee overseeing the company's securitized financial structure, earlier this week sent in an acceleration notice to 4 Fat Brands subsidiaries created to borrow the funds, demanding immediate payment on the company's bonds. Fat Brands, which revealed the notice in the Securities and Exchange Commission filing on Friday, said it does not have the funds on hand to pay all the debt. The payment demand comes after UMB declared Fat Brands in default on its debt after the company did not have sufficient funds to make its quarterly bond payment last month. So the number one thing I want you guys to know is, number one, Fat Brands is in payment default, and the bank that has that loan, UMB, called the entire $1.3 billion loan. Point number two, Fat Brands went on a buying spree in 2020 and in 2021, acquiring nearly $1 billion in restaurant chains, including Global Franchise Group, the owner of brands like Hot Dog on a Stick, Round Table Pizza, and Fazoli's, Twin Peaks, and Johnny Rockets. To make these deals work, the company used a complicated financial instrument known as a whole business securitization, in which companies use their cash-generating assets to back bonds. This is very popular when it comes to these companies purchasing franchises. In the case of Fat Brands, securitization financing enabled the company to go from acquiring low-end restaurant chains for a few $1 million to making several large-scale deals in rapid succession. So point number two, Fat Brands buried their companies in bond debt secured by their future income and purchased franchises. Our third point really represents a systemic problem because they were allowed this money, and they were allowed this money from underwriters and from rating agencies despite financial turmoil. So this is a systemic problem, and this is not even private credit, which is even more unregulated. This is happening on the regulated side. So ask yourself this question: if this is happening on the regulated side, what's happening on the less regulated side in private credit? Well, I'm about to show you that. But first, this is what this is saying. Yet the company itself has struggled with weak sales across its restaurant chains and financial losses. Same-store sales at its restaurant chains collectively declined 3.5% last quarter. That's its 8th straight decline. The company also reported a loss of $58 million. Earlier this year, Fat Brands missed a payment to a marketing firm, leaving one of its concepts, Round Table Pizza, without advertising for several months. Earlier, franchises of Hurricane Grill and Wings accused the company of raiding their marketing funds. So they bought them, took all of their assets, and put it somewhere else, probably to pay off some interest. Fat Brands earlier this month said it has suspended its dividend, though it is still paying dividends on preferred shares. It also said it plans to raise equity from Twin Peaks in a secondary stock offering. Who's going to lend the money? Which has been delayed by the government shutdown. And it would use those funds to pay down debt. So just think about this for a second. legally, they could do this. These corporate companies can do this. They're going to pile on debt from apparently one of their less leveraged up sections of their company to pay off other debt. So let's make debt to pay the debt because we're drowning in debt. And by the way, let's get some more debt so we can purchase some franchises, drowning us even more debt. So I'm wondering now, who's making the commission, bonus, and fees from all of this? Point number 3, credit rating agencies and underwriters fail to stop the debt, even in the face of financial turmoil. Let's take a look at the lender, UMB, who is on the hook for roughly $1.3 billion. UMB Financial, according to Wikipedia, listen to this, guys, is a parent company of UMB Bank, which ranks, now this is the scary part, as one of America's best banks by Forbes and S&P Global Market Intelligence based on 8 financial measures of asset quality, capital adequacy, and profitability. If they're one of the best ranked banks for market due diligence and intelligence, what does that say about the rest of the industry? Can you just explain how this is a canary in the mine?
This is in its own ecosphere, history repeating itself. So I've studied over the years thousands of these business models, and I've seen these aggregators before. And I took a little bit of time and just went and studied what had happened to this company back in 2023 with regard to its C-suite. And you can go and look that up yourself. But the bottom line is, when you pay a premium price to get deal flow, and you buy into an inflationary market where your cost of food, that's cost of goods, your rent, your employee costs are all expanding. They're all going up. Well, regardless of the C-suite's perceived ability to reposition those assets, which those assets may not have even been making money to begin with, well, the combination is a recipe for disaster. And that's what you're seeing play out. And they raised bonds, they used shareholder money as part of their equity for the company to go and do these acquisitions. They probably did some roll-ups along the way with the idea of turning those companies around, such as rolling in the Toll House deal into Great American Cookie. So there's things that they thought they were capable of doing, but as I said, when your cost of product, the restaurant acquisitions goes up, inflation goes up, food goes up, employee cost goes up, rent goes up, the high probability of default, every one of those elements that goes up increases the probability of default. So there may be, and I believe there is, good brands within inside of what they've purchased. The problem is, due to the interest on the debt, they may be in a position where even those good brands get tainted and knocks the entire system down. And then with regard to the method of financing that Travis was referring to, that's called DIP financing, which is debtor in possession. And that typically takes place in and or around a bankruptcy where an outside lender will come in and loan money at a high rate of interest. Generally speaking, that's not a good idea, because if the company doesn't have legs and the ability to pull out of the nosedive that it's in, although the dip gets priority, what do you really end up with if you don't have the ability to run the company? So this is a pretty fair mess.
Any idea or thoughts on how UMD Bank missed this? I mean, do they not have the ability to look under the hood to detect fraud or a company's ability to repay?
The problem with aggregators are that it's a story, right? Well, we have the ability to come in and fix this other people's mess. But in doing so, the story magnifies the problem. Well, we're going to fix this. Oh, well, that one didn't work, but we're going to fix the next one. Oh, that one didn't work, but we'll fix the next 2. Well, that didn't work. Well, we'll fix the next 4. So basically, you end up with either a Ponzi scheme or a debt scheme, to be determined which is which, but you end up in a situation where there's no way out of it. The debt gets worse by virtue of the interest. And at that point, because of all the problems with inflation, if you think of it this way, your debt has superseded your principal and knocked down by virtue of the inflation in the system. it's a mess. I mean, there's no other way to look at this.
Mitch, maybe I should have looked before doing this video, but what do you think the probability is that some of those bonds that were issued from that company went into either 401k or pensions?
Oh, more than likely, because there's bond buyers buying all sorts of stuff, and it'll be a very small percentage of their portfolio, generally speaking, but more than likely, yeah, probably.
I can't help but sit back and just ask how and why did this happen? And honestly, I think if we can reverse the space-time continuum and go back in history when 401ks and pensions first started, and we can sit there and explain to mom and pop how much of their retirement money is actually being disrespected. I mean, they're disrespecting it. They're beating it up. They're trying to squeeze as much commission out of it as possible before someone raises their hand and said, hey, enough is enough. It's debauchery, Mitch. Pensions right now in 401ks, it's a failed concept that never worked. It only worked for the benefit of the bankers.
I think the answer to your question is, how does it get to this point? A lot of human psychology is at play here. So if you go back to its inception, the idea of an aggregator company, General Electric, by the way, was an aggregator. When they start buying other companies, they become aggregators. But very few of them have the ability to run the underlying company. Just because you think as a Wall Street analyst, you have an idea on how to make something work, doesn't mean you can stand on the floor and make that company run, make that individual unit run, make that franchise run. So a lot of this has to do with, well, we bought it, it didn't work, let's go buy another one, we'll try it again. And like I said, so they start aggregating, start buying these things under a theory, while our company is now going to start buying these quick service restaurants, and we're eventually going to end up with a cash flow. But in the last several years, you can go back 6 years, and that statement just simply isn't true. When inflation started to run, that put the probability of default also starting to run, because your employee costs run, your overhead, your rent runs, everything goes up. Cost of electric, doesn't matter what it is, your operating expenses are running. Well, if your median household income doesn't exist for that particular franchise location, call it Toll House cookies. Well, if people aren't buying those cookies in that general vicinity, you're done. I mean, that store is finished. They would have been much better off saying some other type of acquisition, which is, okay, landlord, we're going to work this out, but here's what's going to happen. They didn't do that. They didn't bring the rents down. They didn't bring the expenses down. They chose to go in the other direction, which is keep acquiring and hope for the best.
And they're packaging that up and say, hey, it's still good. It's still good. They just said it. We're going to create more bonds from Twin Peaks. And they're going out of business, but they're still going to do it. I don't know what to call it except a Ponzi scheme, Mitch. Speaking of a potentially even worse Ponzi scheme, let's now go into a fairly thorough breakdown on what's happening in the private credit markets. I'm going to use a breakdown of the private credit markets that was derived from AI analyzing 17 different articles. So after AI analyzing 17 different articles, here's what AI is saying about private credit markets. Public traded business development companies, or BDCs, managed by firms such as Blackstone, Oaktree Capital Management, and OFS Capital, have trimmed dividends by over 9% this year, indicating financial stress. Private credit lenders experiencing financial turmoil. The private credit market is currently experiencing financial shifts, with some prominent lenders facing challenges, even as the sector continues to grow. Anxiety within the market has led to a decline in the shares of major private credit firms like Apollo Global Management, Blackstone, and KKR, which have slipped by over 14% on average just over the last quarter or 3 months. This occurred despite the S&P 500 rising by nearly 10% during that same period. Business development companies under stress, so BDCs, which are tax advantage vehicles that raise capital from small dollar investors to make loans, have been particularly affected. Public traded BDCs, including those managed by Ares Management, Blue Owl Capital, and KKR, held approximately $155 billion earlier this year. Insane. However, amid a wave of loan market blowups involving companies like auto parts maker First Brands and 2 telecom firms accused of fraud. And that's just what they found. Remember that. That is just, it's like cockroaches. If you find a couple on the surface, you go behind the walls, there's a lot of them. There's a whole colony of fraud that's going on that they haven't even discovered yet. BDCs have begun to trade at a discount to their asset value. This discount signals concerns among investors considering backing closed-end credit funds. Signs of broader market stress. Beyond formal defaults, there are other indicators of stress in the private credit market. The use of payment in kind, or PIK income. Remember, we did a video yesterday showing you guys that PIK income is really just defaults. They're covering up Chapter 11 bankruptcies with PIK. So we don't know what's going on. That's part of the problem. PIK income, where interest is added to loan balances instead of being paid in cash, has increased. So that's probably something to the effect that they're doing in the CMBS market, or commercial mortgage-backed securities. Instead of like taking over their property, they're extend and pretend. So PIK is like extend and pretend. It's like that. For public BDCs, PIK income accounted for nearly 8% of investment receipts as of June, and that's up from 6% from 2 years ago. Across the broader private lending universe, PIK climbed to approximately 11% of income, 1/10 of income, over 1/10 of income in June. When distressed exchanges and other quiet restructuring are factored in, the sector's effective work rate exceeds 4%, more than double the courtroom default rate. The surge in syndicated loan volumes, which hit the 3rd highest quarterly tally ever from June to September. What is your opinion on what some of the worst challenges private credit is facing right now?
Okay, how about this? The worst challenge that private credit is facing is that they don't have any equity in the deal, or very little equity. So they're super highly levered to begin with, and they get the majority of their money from the upstream lender. Could be JP Morgan, Morgan Stanley, doesn't matter who it is. But generally speaking, that's what's happening. So you've got one layer of leverage upon another layer of leverage. And as I've said dozens of times in these videos, most people, including institutions, can't handle debt because they don't know the power of the compounding of interest. And it's unquestionably way over and above what they should be doing. That should be job one, is how are we going to pay this off? And these CEOs, they do have fiduciary obligations. There are laws to protect people from these types of problems. But if those laws are chosen not to be enforced, well, we're right back to the school districts. The exact same thing. It doesn't matter whether it's a school district or the company that's an aggregator. If they can't handle the debt, it becomes human nature. Well, we screwed it up. We don't want to admit that we screwed up. So let's commit fraud and try to get our way out of it. That's the turning point when fraud starts. It's not that the concept was bad to begin with. It's that it got out of control. And when it got out of control, in every one of these instances is when the fraud starts. Just a question of, can they use the fraud to cover it up? In most cases, no, but they try. And we end up where we are now on a global problem basis because the debt's gotten so far out of hand, i.e. Japan at 228% of gross domestic product. And when you see these problems, eventually the chickens come home to roost.
When I take a step back, it seems like the Federal Reserve and the government and the politicians and the enforcement agencies have intentionally created this mess for us to fail, because we know we've already failed. Alan Greenspan, one of my favorite, aha moments when I was watching Alan Greenspan is when he acknowledged to Congress that he underestimated the human heart. He underestimated how many people chose greed, commission, bonus, and fraud over their duties as a professional. Can we just say now, Mitch, that the Fed and the government wants us to fail? Because the more that mom and pop continues to get rug pulled and the more that we continue to make bad decisions, the more the elite and top-ranking bankers win. Is that fair to say?
Not really. I mean, it's not that they set out to cause these problems. It's their ignorance and not understanding money and what money is that has caused these problems. Nobody wants to take the hit under their time in office to say, we're going to fix this once and for all. It's going to end up doing it itself. That's my fear, is that the market will fix this rather than controlled demolition. I'm in the camp, we need controlled demolition, and we know how to get out of this mess. But to your point, on a larger scale, printing money is in fact a default. When they've printed trillions of dollars, not backed by assets, they printed it based on another problem that they created. Well, that's ignorance. They don't understand the money. They don't understand the problem that they created. I'm pretty sure they understand the ramifications. They just don't want it on their watch. We've seen this when the courts are punting. There's no way that the politicians, there's no way that the Federal Reserve, there's no way that this administration, prior administration to that, prior administration to that, going all the way back to Nixon, did not understand you don't print money unless you've got an asset. Yet they all did it.
Yeah.
Nixon took us off the gold standard. That's when these problems really started to move. And you can go back and look at the charts. So it's not that they didn't know. It's that they didn't understand the ramifications.
It seems like there's someone in control of both parties. And each time the parties flip, like Republican, Democrat, each time that flip happens, more freedom's taken away, more liberty's taken away. Life as we know it changes, it gets worse. And other people that we don't even care about, that aren't helping us in any capacity, make even more money, and they take our rights and they profit from the rights that they just took from us. That's what it seems like.
That's the debt and debauchery that has occurred throughout history. The Roman Empire, Spain, Italy, they've all collapsed. You know, you say Italy is part of the Roman Empire, but recently. So they've all collapsed. When the creation of the European Union was started, the Italian lira got destroyed overnight, 32%. So these things have happened in history multiple times. Great Britain has been bankrupt multiple times. They're bankrupt again right now. So this is not just an American problem. It has festered under American leadership through the Federal Reserve. So you have the International Monetary Fund, which is just a mirror of what the Federal Reserve wants. The Federal Reserve has come in to rescue banks in Switzerland, as an example. So these things have happened multiple times in history. It's just, it shouldn't, because the people that are in charge never understood compound interest. They never understood how to control the debt. And that's why I've been jumping up and down on some of these companies saying, as far as I'm concerned, your threshold, your debt ceiling is 30%. End of story. Because then it's controllable.
But honestly, Mitch, I think when you say those things, it pushes me even more to think that they do this on purpose, right? Because here's why I say that. You said it yourself. It's been happening for hundreds of years. It's happening in other countries. The same pattern and practice, the debt and the debauchery, has been happening everywhere forever. So to me, it means they're not using the math. They've never used the math because they don't care about the math, because the real problem here is the human heart, is the greed, corruption, and fraud. And that's why, to the viewers, and I hope you guys understand why I keep saying this, is why I keep telling you guys, go out and love someone. Is that not what life is supposed to be about? And I was thinking about this last night. It's not new. We know about this for hundreds of years. The problem is thousands of years, maybe even longer. The problem is the public, the people, the large number of us, we just stop caring, or we forget, or the apathy takes over, or we're drowning in debt and we're just trying to make sure our children are okay. There's so many things that are happening right now that is absolute debauchery, and it's sad. And speaking of absolute debauchery, Mitch, let's talk about the Federal Reserve. Coming out just 3 hours ago, November 24th, right here, Fed's Waller, December rate cut appropriate, but January action more uncertain. And this is from Fox News, and this was picked up from another media company. And I was telling Mitch, like, yeah, they're flipping. Oh my gosh. And Mitch is like, who cares? I'm like, yeah, I agree. Who cares? But for some reason, a lot of people want to know what's going on with the Fed. The only thing that the Fed is doing to affect us is robbing us, maybe a little less quickly. But their design is to rob us, is to take the tax money and to bail out the banks. Just 3 bullet points. Fed divided on December rate cut. Recent comments favor reduction. So again, this is flip-flopping. A week ago, there was like, no way they're going to cut rates in December. But before that, they're like, yeah, so it's flip-flop, flip-flop. Fed still won't have data, delayed by the shutdown available. Why? Why can they not have that available? I mean, seriously, isn't the data just the data? Give us the raw data and just do some math. Why are they cooking the books? I mean, why are they hiding? I mean, I apologize. Why are they delaying the data? January decision more uncertain based on upcoming information. When we look at CME FedWatch, look at this flip. It's unbelievable. 79.1% of the market is now expecting a rate cut in December. 2 weeks ago, it was the opposite. And then before that, it was the opposite. So it all goes back to this question, Mitch. Who cares? Why do we need a Federal Reserve anyways? Why are so many people worried about what the Fed does next? What we need to be focused on, at least in my opinion, is going outside and loving some people.
Do you know that you could take a 5-year-old, give that 5-year-old a quarter, heads, interest rates go up, tails, interest rates go down. That 5-year-old can achieve something in 4 seconds flat that the Federal Reserve, with all 23,000 employees behind it, takes months to figure out for them to make a decision. The entire Federal Reserve is a complete waste of time. Now, I made a comment about the idea of history, and this has been going on for thousands of years. If you go to Wikipedia and type in Medici family in Italy, what you will see that will come up is the history of the banking system in the Roman era. Its entire history, including the debt and the debauchery associated with the Medici family. It's absolutely fascinating. There's books written about it. And again, history repeats itself. Well, even in today's world, there are very wealthy offshoots of the Medici family still in control of the banking system in Italy. They still exist. It's not the same format, not with the same power. But if you go to Wikipedia and look at the amount of industries that the Medici family was involved in, it's astonishing. Glass blowing, fishing, bread making, you name it, they owned it, they controlled it. So they ended up controlling it by virtue of putting debt on those items, those companies, those people, and saying, okay, you can't make the payment, we'll take the company. So these problems are all directly correlated to what we're talking about here, in that who does the Federal Reserve work for? They do not work for you or I, mom and pop. The Federal Reserve works for the banks. When they print money, it's to keep the banks alive. The banks screwed up, they made loans they had no business making loans on. So the history of these problems has existed for thousands of years. Do they intend to crash the system? Probably not. Is it a ramification because they refuse to deal with the issues that they've created? Probably. Point being that when you look at what Travis just referred to with, well, we're going to raise interest rates, we're going to lower interest rates, this is nothing more than kabuki theater. It's not relevant to anything. Look at how much money and time gets spent by some idiot coming up with this idea, well, we have to put this press release out. For what purpose? It doesn't matter. It shows up in a chart. This is one of the reasons why I don't pay attention to the press. I don't want any of this nonsense dancing in my head. I look at a chart, I get exactly what I need. Don't need to be listening to people writing articles that don't have a clue what the ramifications are of what those articles even mean. So where I'm going with that is don't be manipulated. Look at the homework yourself and make your own decision. Don't listen to the press because generally speaking, they're wrong. And it's because they refuse to do their job that we're in this mess to begin with. They refuse to ask the right questions.
Let me try to ask the right question then, Mitch. In your opinion, okay, I want to give my answer, but what should mom and pop focus on? I've already told the viewers what I think that they should focus on. Love, serving people, the relationships, going outside, getting off electrics, things like that. I'm a little more emotional than you. And when I say a little more, I mean a lot more. So Mitch, what should mom and pop be focusing on right now? What do you think?
These times are tough and they're going to get a lot tougher. That's just the reality. I hope I'm wrong, but I'm not. So if you have something in your life, someplace to go to do something that's bigger than you, including just maybe visiting a couple of days a week with a senior, somebody whose mind isn't there, whatever it happens to be, it's something that is bigger than you. That's a great place to start. Next issue is if you can get out of debt, which is very difficult, but if you can get out of debt, you will be in much better position. If you have cash in the bank and you're worried about having cash in the bank, If you've got 3 or 4 or 5 months of cash in hand, I don't care if you're buried in a coffee can in the backyard for emergency funds, that is a good thing to do. You can't trust what's happening in the world right now. When you look at Japan with its debt to GDP at 228%, give or take, and you look at Germany that is dancing on a Great Depression, and I mean within days dancing, it's very bad. They've got cities in Germany, multiple cities that are bankrupt. Start adding that up and you've got a serious problem. You look at our debt load, you look at London, these are all very serious canaries in the coal mine. China, same problem as Japan. It's not the debt to GDP, it's simply the debt versus the income. You look at AI, it's the debt versus the income. These problems are everywhere. And then that, speaking of AI, one other point, AI is okay, but it makes mistakes. Don't trust AI. Do your homework. It's okay to listen and say, well, okay, AI gave me several sources. Go back and double check the sources. Make sure the sources are real. So you can't trust the press because they're doing things that make no sense other than to protect the press. They're not acting in the best interest of mom and pop. Do your homework, get out of debt as best you can, and just understand what's coming. And then in order to take the heat off and the psychological problems that are associated with this, go and find something that's bigger than you. Go and work in a food line just for a day, one day a month, just something to do that's bigger than you.
Well said, Mitch. You heard it from Mitch directly, okay? Something bigger than you, and that means literally probably anyone outside of you, right? Literally anyone in need at all. And we have a lot of people in need. Trust me, you don't have to look very far. Now, having said that, if you are struggling, understand this, you're not alone. Tomorrow is a new day. You are important. You are loved. So hang out with us. Grow with us, learn, share, all those things. Follow the links in the description. Go to my Facebook, go to Mitch's website, mockingbirdproperties.com, and start joining the conversation and become part of the solution. Now, other than that, guys, if you're out there investing in real estate, trying to figure out what's going on in the economy and in life, you guys already know we wish you luck, and we hope you win.